Hi there, welcome to the EXP Group's Express Notes. We do provide short lectures on every one of our topics for F6, as we do with all the other courses. I assume you would have accessed our website, so you would know the name of our website, which I will not give to you now, but hopefully you remember it. So welcome to F6. We will now do a short overview of the functions and purposes of taxation. Taxes are levied to obtain the necessary funds and to ensure the efficient day-to-day running of a country. Adam Smith provided 4 maxims by which all tax systems should work. There are 2 types of taxes. Either you have a direct tax or you have an indirect tax. A direct tax is an example of which is income tax. It means you earn the money and tax is levied on that amount of money. That is what is referred to as a direct tax. An indirect tax is value added tax, where you go out, you spend your money buying a good. You pay 10 Rand for that good, but there is an amount of 14% levied on that good that is known as value added tax. So you are not paying the tax directly, you're paying the tax indirectly to a vendor who then has to pay it over to the South African Revenue Services. Assume at this stage you all know that our collector of tax in this country is the South African Revenue Services, or SARS as we commonly love to call them. The administration of tax is administered by the Income Tax Act 58 of 1962, a lovely little book of about 2,000 pages. The tax board, the tax court, the provisional division of the highest court, and then the highest court of appeal. So you literally have to start. If you do not adhere to the provisions of the Income Tax Act and you have a problem, you will go to the Income Tax Board. If you don't like their decision, then you go to the tax court. If you don't like the tax court's decision, then you go to the provisional division of the High Court. And if you don't like their decision, then you go to the highest court of appeal. You cannot go from Income Tax Act to the highest court of appeal. Unfortunately not. Income tax, there are 5 different kinds that we look at. We look at the normal tax, which is levied on individuals and corporate entities at different rates. We look at turnover tax. We look at donations tax. We look at secondary taxation of companies, and I have / dividends tax because as of the 1st of April 2012, which you do not have to know for this course, but you will definitely have to know in future, it has been changed to what we call a dividends tax. And then we have a withholding tax, which is how we tax non-residents in this country. A normal tax for individuals only. We have the following rebates that apply. A primary or a natural rebate of 10,755 Rand. A secondary rebate, which is available to individuals 65 years and older, which means they will be eligible for the primary rebate of 10,755 Rand plus the secondary rebate of 6,012 Rand. And then we have a tertiary rebate for which any individual over the age of 75 years will get the primary rebate of 10,755 Rand plus the secondary rebate of 6,012 Rand plus the tertiary rebate of 2,000 Rand. Year of assessment, we need to define what a year of assessment is, and for all individuals and natural persons it runs from the 1st of March to the end of February. For the year that you are looking at, it will be from the 1st of March 2011 to the 29th of February 2012. Unfortunately, it was a leap year, or fortunately, it was a leap year, whichever way you like to look at it. For companies, it is always the last day of assessment of the company's financial statements. So if you have financial statements that run from the 1st of January until the end of December, for that particular company, the year of assessment would be the same. It would run from the 1st of January to the end of December. But remember, this is only available for for companies. Any person other than a company will have to use the normal tax year, the 1st of March until the end of February. The other tax that we levy, and as you can see we do levy a hell of a lot of taxes, is capital gains tax. Capital gains tax is levied on residents and those people deemed to be in residence. It is a tax on the disposal or deemed disposal of a capital asset, and we levy an amount depending on the inclusion rate, be it a natural person or a corporate entity. The next thing we do is a donations tax, and certain donations are subject to tax at a flat rate of 20% on all donations made. Secondary taxation on companies is levied at a rate of 10% until the end of March 2012, after which we have a dividend tax of 15%, which is levied from the 1st of April 2012. However, we have a slight shift in administration, if you would like to call it here. Our secondary taxation on companies until the end of March, the company was liable for the tax being paid. Although the dividend tax says that the company is still liable for the amount of 15% paid, this amount will now reduce the actual dividend that any shareholder gets. So if before the 1st of April 2012, if you earned 100 Rand in dividend, you would get the 100 Rand in dividend, because the company would pay the 10 Rand secondary taxation on companies. After the 1st of April, if you are liable for 100 Rand, you will only get 100 Rand less 15%. Excuse me. A withholding tax is a tax that is levied on non-residents, and it is payable by the South African resident. So if you are employing a non-resident, you will have to withhold from the non-resident's remuneration an amount of, if it's royalties, an amount of 12%. If it's fixed property that you have acquired from the non-resident, it's between 5 and 15%, and for sports persons and entertainers, it's 15%. The tax framework, this is what we lovingly call the tax framework, which you will have to know backwards. The first thing we look at is gross income, which is found in Section 1 of the Income Tax Act 58 of 1962, less exempt income, which is found in Section 10, which means exempt income actually reduces your gross income and it gives you what you call income, less any allowable deductions, which are housed in Sections 11 to 19 and Section 23, which also reduces your income. You add any taxable capital gains and you will get taxable income. Your normal tax is then levied on this taxable income. It is levied on no other amount but your taxable income. All the other taxes that can be paid would be value-added tax, transfer duty, stamp duty, estate duty, and securities transfer tax. And tax avoidance and tax evasion, we would like to point out here that tax avoidance is the legitimate sorting out of your affairs so that you would pay the least amount of tax possible. However, tax evasion is an illegal way of reducing your taxable income. That is it for your chapter 1. I will see you at chapter 2. Goodbye. Happy studying.